Welcome back to Talk Tickers, the show where we digest earnings calls so you don't have to. It is February 8th, 2026, and today we are dissecting a company that is kind of performing open heart surgery on itself in public. We're looking at Healthpeak Properties, ticker DOC.
It's good to be here. And surgery is absolutely the right word. This isn't just a standard earnings review. I mean, we are looking at a massive healthcare REIT that's literally chopping itself in half to navigate a very, very strange market.
Exactly. And if you're a shareholder, you probably have a bit of whiplash this morning. We're talking about their Q4 2025 earnings. And on paper, the numbers looked great. They beat earnings. They beat on revenue.
Oh, yeah.
But the market, the stock closed down almost 3%, ended at 1645.
And the volume was the tell. You saw, 19.4 million shares trade hands. Their average is usually around 8 million. So that's institutions running for the exits, or at least, aggressively repositioning.
So that's our mission today. We need to explain that disconnect. Why does a beat lead to a sell-off? We're going to unpack this Janus Living spinoff, which is the biggest structural change they've made in, a decade?
At least. And we'll look at why their lab segment is just bleeding cash and decode management's warning that 2026 is going to be a trough year.
And you'll want to stick around for the end because our not financial advice segment is, it's a bit wild today. We found a detail about a drone company that might just change how you think about empty lab space.
I'm still trying to wrap my head around that one, but we'll get there.
Okay, let's start with the hard data, the Q4 snapshot. Because to a casual observer, this looked like a victory lap.
It really did. If you just scan the headlines, you'd think everything was perfect. GAAP EPS came in at 16 cents versus a consensus of just 7 cents. That's a huge beat.
And revenue.
Revenue hit $719.4 million. That beat expectations by almost $28 million.
And for the REIT heads listening, the FFO numbers look solid too.
All right, narrowed FFO and adjusted FFO both hit 47 cents per share. And just a quick refresher for anyone new to REITs, we look at FFO, funds from operations, because standard earnings, they include depreciation.
Which doesn't really apply to buildings.
Exactly. A building doesn't wear out like a factory machine. So FFO adds that depreciation back in to show you the real cash flow.
So cash flow is solid. The machine was working just fine in 2025, but the market isn't trading on 2025 numbers, is it?
Not anymore. This sell-off was 100% about the forward guidance.
About 2026.
Entirely. Investors looked right past the rearview mirror and saw a cliff approaching. Management basically came out and said the party's over for a year. They guided 2026 FFO to a range of $1.70 to $1.74 per share.
And just for context, they finished 2025 at $1.84. So that's a big step down.
It's a huge one. In the REIT world, you want steady, boring growth, a drop from 184 to, say, 172. That's jarring. Management is calling this a reset or a trough year.
Trough year is CEO speak for we are dumping all the bad news into this calendar year so the comparisons look great next year.
It is the classic kitchen sink quarter. They're clearing the decks. But to really understand why the earnings are shrinking, you have to tear the company apart. Healthpeak is really 3 different businesses stitched together.
Senior housing, outpatient medical, and life science labs.
And right now, those 3 are moving in completely different directions.
Okay, let's start with the one that's actually working. The star of the show, senior housing.
This segment is absolutely on fire. We're finally seeing that silver tsunami demographic wave really pay off. They posted 17% same-store net operating income growth in Q4.
17%.
17. And for the full year, it was up 12.6%.
I mean, double-digit growth in real estate is almost unheard of. You're usually happy if you beat inflation by a couple points.
Precisely. And this incredible performance is what triggered the biggest news of the call, Janus Living.
The spin-off. Walk us through the logic. Why take your best-performing asset and just spin it out?
Because management is frustrated. They look at their stock price, and they see it trading at a low multiple, and it's being weighed down by that struggling lab business.
Right.
Meanwhile, pure-play senior housing stocks are trading at these huge premiums because of that growth we just mentioned.
So it's a sum of the parts argument. The market isn't giving them credit for the gold mine because it's buried under a pile of empty labs.
That's it. So they are spinning off the senior housing portfolio into a new publicly traded REIT called Janus Living. They filed the confidential S-11 with the SEC, and expect to close it in the first half of this year.
But it's not a total divorce, is it? It sounded like Healthpeak is keeping its fingers in the pie.
It's a sponsored spin.
Yeah.
Healthpeak will keep a majority stake in Janus Living, and this is the crucial part, they'll act as the manager.
So they collect management fees.
They collect fees, and they still benefit if the Janus stock goes up.
Okay.
It's clever. They get to tell the market, look, here's a pure growth stock while still keeping those income streams.
And they're spending money to clean it up before the launch. I saw they bought out a joint venture partner.
Yes, a sovereign wealth fund. Healthpeak spent $314 million to buy out the remaining interest in a portfolio of 19 communities.
That is a lot of cash to drop right before you spin something off.
It is, but it's about control. They want to hand these properties over to their preferred operators to really tighten things up before the IPO. They want Janus to launch looking absolutely pristine with no messy JV structures.
Okay, so senior housing is the golden child leaving the nest. Let's move to the middle child outpatient medical, the rock of the portfolio.
This is the boring part, and I mean that as a compliment. This segment is about half their income. It's doctors' offices, clinics, that kind of thing. They posted steady 3.9% growth, 91% occupancy.
And this is where that big merger with Physicians Realty Trust is finally showing up in the numbers.
Right. They cited over $70 million in synergies. They basically built the dominant platform for medical office space.
Yeah.
But here's the nuance. They aren't treating this as a growth engine.
How so?
They're treating it as a piggy bank. They are net sellers here. In Q4, they sold $325 million worth of these medical assets, and they sold them at a very low 6% cap rate.
So a low cap rate means they sold for a high price, right?
Exactly. A low cap rate means the buyer is accepting a lower return because the asset is so safe. So Healthpeak is selling these safe, expensive buildings to raise cash.
And where does that cash go? I think that brings us to the problem child, the third leg of the stool, lab and life science.
The anchor. And not the good kind of anchor. This is what is dragging the whole ship down.
The numbers here were just rough. Same store growth dropped to 1.5%. Occupancy is at 77%.
And the guidance for 2026 is brutal. They expect lab NOI to be down 5 to 10%.
So that's the sell-off right there.
That's it. And to understand why it's falling so hard, we have to talk about the lag effect and triple net leases.
Okay, break that down. Why the...
So management was really keen to point out that leasing activity is actually picking up. Their pipeline of potential tenants is up 50% from last year. But in life science, you don't just sign a lease and move in.
These are complicated buildings.
Super complicated. You need special ventilation, reinforced floors, hazardous waste disposal. The build-out, the tenant improvements, can take 12 to 18 months.
So they might sign a lease in 2026, but they won't see a dime of rent until 2027.
Correct. But it actually gets worse. Most of these are triple net leases. So in a triple net lease, the tenant pays the rent plus the taxes, insurance, and maintenance.
Standard stuff for commercial real estate?
Right. But when the tenant leaves,
Yeah.
the landlord doesn't just lose the rent check. The landlord suddenly has to pay all those operating expenses themselves.
So your revenue goes to zero and your expenses shoot up at the same time.
It's a double whammy. They even quantified it. They said there's a 12-cent earnings hit in 2026 just from this vacancy drag carrying costs on empty buildings and the money it takes to release them.
And on top of that, they took another hit in Salt Lake City.
Yeah, a $68 million purchase option was exercised. Basically, a tenant had the right to buy their building, and they did. So that took a chunk of income off the books right when they needed it most.
So 2026 is the year they just have to swallow the pain on vacancy. But this brings up a massive contradiction in their strategy.
Mm-hmm.
We just said they're selling their safe medical buildings. We know the lab market is struggling. Yet, in the middle of all this, they went out and made a massive acquisition in the lab space.
The Gateway acquisition. This is easily the most controversial thing they did all quarter.
Everyone else is running for the hills, and Healthpeak doubles down. They bought the Gateway campus in South San Francisco.
And this is not a small property. It's a 1.5 million square foot campus.
Yeah.
But here's the kicker. And the reason some investors are getting nervous, it currently has 500,000 square feet of vacancy.
So they bought a building that's 1/3 empty in a market where occupancy is already falling. That sounds reckless.
It is certainly aggressive. They bought it from a distressed JV partner who needed the cash. Management claims the price was so low that it's a break-even deal on day one, even with all that empty space.
So what's the real play?
Market dominance. They now own 210 acres in South San Francisco. That's roughly 1/3 of the entire submarket.
That's a monopoly board strategy. They're trying to corner the market on the premier biotech hub in the world.
That's the thesis. They're saying the recovery is coming. When it comes, everyone will want to be in South San Francisco. And when they come, they'll have to rent from us. They're selling stable assets to buy distressed ones because they think the bottom is in.
But is the bottom, I mean, what did they say about the macro context? They mentioned green shoots.
They did. And honestly, the data does support them, even if the rent checks haven't shown up yet. Since last fall, the capital markets for biotech have thawed. VC money is flowing again. The IPO backlog is building.
And the FDA is back to work.
Right, 52 drug approvals last year. That's back to normal levels. When the FDA approves drugs, companies get funding. When they get funding, they rent labs. It's a simple cycle. It takes time.
But there's one detail on the tenants that really caught my eye, and it hints at something bigger than just biology.
You're talking about the drone company.
A drone company. Management explicitly said they signed a lease with a drone manufacturer who just raised $600 million. Since when do drone companies need biolabs?
This is where the whole definition of life science real estate is sort of shifting. Think about what a modern lab offers. It has extremely heavy power capacity, reinforced floors for equipment, high ceilings, loading docks, advanced HVAC.
So it's basically high-spec industrial space.
Exactly. And who needs that right now? Deep tech, robotics, AI hardware companies. Management is signaling that their pool of tenants isn't just people with test tubes anymore. It's people building the future of hardware.
So the sentiment is neutral to cautious for 2026 earnings, but the activity on the ground, drones, VC money, FDA approvals, it all suggests the turnaround is real.
That is the bet. They're asking you to ignore the 2026 income statement and look at the 2027 balance sheet.
Okay, so we have a company splitting in two, taking a trough year and betting the farm on South San Francisco. Let's move to our favorite part of the deep dive. We take these facts and see if there's an angle the market is missing.
And here comes a disclaimer. We are not financial advisors. This is not financial advice. This is purely a thought experiment based on the call.
Absolutely. Do not trade on this. But if you were pitching a high-risk, high-reward idea to a hedge fund committee based on everything we just heard, what's the play?
I call this trade the Silicon Valley squat and swap.
I like it. Walk us through it.
Okay, the logic is based on that convergence of AI, tech, and bio we just talked about. Healthpeak just bought the Gateway campus. Huge vacancy, huge power capacity, right in the heart of the Bay Area.
Okay, step one.
Step one is an arbitrage play. You go long Healthpeak, the DOC ticker, right now, but you're only doing it to get the spinoff. You want those Janus Living shares. The senior housing story is undeniable. That part's your safety net.
Okay, so the spin happens. You keep Janus because, demographics. What do you do with the Healthpeak stub that's left over?
This is where it gets fun. The market sees the remaining Healthpeak as just a struggling biotech landlord. I think you reframe it. You hold that stub as a leveraged call option on AI infrastructure.
AI infrastructure, that seems like a leap.
But is it? We know data centers are completely full. We know power is the scarcest resource in California. Healthpeak is sitting on millions of square feet of power-ready industrial-grade shells right there in South San Francisco. If the biotech recovery is slow, who fills that gap?
The drone guys, the robotics companies, the AI hardware startup.
Exactly. If an NVIDIA or some humanoid robot startup needs 1 million square feet of R&D space next year, they can't wait 5 years for a new building. They need it now. Healthpeak owns the inventory.
So you're essentially squatting on the land and the power grid, waiting for the tech overflow to spill into these empty biolabs.
You pitch it not as a healthcare REIT, but as an AI infrastructure play. You're buying distressed labs at a discount, but what you might actually be holding is future deep tech HQ inventory.
That is surprisingly plausible. It turns the vacancy from a huge liability into a strategic asset, assuming that demand shifts from biology to silicon.
And you get paid a pretty nice dividend while you wait for the robots to move in.
I love it. Again, purely wild speculation, but it does connect the dots between that drone lease and the massive land grab they just made.
It definitely makes the trough year look a little more interesting, doesn't it?
Okay, let's wrap this up with the key takeaways for you. Healthpeak is in a major transition. Q4 2025 was a solid look in the rearview mirror, but 2026 is absolutely the year of the reset.
The earnings are guiding down significantly as they digest all this vacancy. The bright spot senior housing is being spun off into Janus Living in the first half of the year, which should unlock a lot of value.
And that leaves the core Healthpeak fighting it out in the lab segment. They're selling their safe, stable assets to double down on a distressed, high-risk, high-reward bet in San Francisco.
And they're betting that all those green shoots of VC funding and FDA approvals will turn into rent checks by 2027. The big question is whether they're just early or if they're catching a falling knife.
We'll be watching to see if that Gateway campus fills up with scientists, or if it stays empty, or, hey, maybe it just fills up with drones.
Time will tell.
Thanks for listening to this deep dive. We'll see you next earnings season.